You work hard for a specific amount of money, you put it in a savings account, and then you watch it earn $11 over the course of a year. Meanwhile, you read headlines about wealthy investors generating massive returns using financial strategies that seem entirely cordoned off from the rest of us. This funnel chart shows exactly why you feel locked out. At the top is the global investable asset universe, approaching $400 trillion. At the bottom is the tiny sliver most regular retail investors actually participate in, less than 1% of the total picture. To understand the whole machine, you need to look at the 5 distinct ways money actually grows: mutual funds and ETFs, hedge funds, private equity, fixed deposits, and alternative assets like crypto and venture capital. When you look at those 5 options, a clear dividing line appears. On one side, you have the highly accessible public money. On the other side, the highly exclusive private money. Getting past the reliable, boring returns of standard savings and crossing over into high-yield wealth generation requires crossing that specific wall. Every single financial product on that list is simply a tool. Each has a specific cost of admission, a specific timeline, and a specific risk level. Taking an exclusive, high-powered tool and applying it to the wrong financial job will actively destroy your wealth. People often look at the highest advertised return and assume that is automatically the correct place to put their cash. The data tells a very different story. Building a wealth engine that survives market crashes and actually aligns with your life requires understanding the strict mechanics of both public and private markets. This comparison matrix breaks down your exact options, starting here with the accessible core. Mutual funds and exchange-traded funds, or ETFs, represent the democratic entry point to the stock market. These funds pool money from thousands of investors to buy a massive, diversified basket of stocks or bonds. Instead of betting on one single company to succeed, you own a microscopic piece of hundreds of them at once. But notice the internal trade-off here. Active mutual funds charge an average expense ratio of about 0.38%. to have a professional try to beat the market. Passive ETFs simply mirror an index, dropping that fee down to roughly 0.16%. That fraction of a percent might sound irrelevant, but fees scale with your portfolio. They take the exact same percentage of a much larger number over decades. Even if an active manager performs well, compounding fees silently drag down your final net worth. This math is why Warren Buffett routinely advises ordinary investors to ignore expensive active managers and stick to passive, low-fee index funds. Over a long enough timeline, the cheaper average approach almost always wins out. At the complete opposite end of the public spectrum, you find the absolute safety floor: fixed deposits or certificates of deposit. A CD is simple. You give a bank your cash, they lock it up for a set period, usually 1 to 3 years, and pay you a guaranteed yield. If you are in the US, the FDIC insures that money up to $250,000. Even if the entire bank collapses, the government ensures you get your principal back. But total safety carries a hidden tax. Right now, the best CDs pay around 4%. With inflation running at 3.8%, your money is technically growing, but its actual purchasing power is barely moving forward. The public foundation gives you liquidity and guarantees, but it relies entirely on long-term patience. These tools do not possess the mechanical capacity to create massive overnight wealth. Now look at the other side of the wall. This new row is the exclusive hedge. To enter a typical hedge fund, you need an absolute minimum of $100,000 to over $1 million in capital, plus legal status as an accredited investor. They demand that exclusivity because they operate with almost zero regulatory restriction. They can aggressively short stocks to bet on failures, or borrow huge sums of money to amplify their trades, tools regular mutual funds cannot touch. That aggression comes with a brutal cost structure: 2 and 20. You pay a 2% management fee on your total money every year, plus the fund manager takes a full 20% of all the profits they generate. With fees that high, you might expect guaranteed dominance. But in 2024, hedge funds delivered an average return of 11.9%. The basic, accessible S&P 500 returned 23.3%. The million-dollar exclusive funds routinely lose to the average market during good years. Wealthy investors tolerate that math for one specific reason. When the broad market panics and standard portfolios plummet, hedge funds are designed to limit the bleeding. A hedge fund is an ultra-expensive insurance policy to ensure a massive fortune doesn't evaporate. It is not a magical wealth creation shortcut for the middle class. Private equity takes a completely different approach. Instead of buying shares of stock, these firms raise huge pools of capital to buy entire private companies, restructure them for maximum efficiency, and sell them years later. This final row tracks the high-reward illiquidity tier. Over a recent 23-year period, private equity allocations averaged an 11% annualized return net of fees, easily beating the 6.2% delivered by public stock markets over that same span. That outperformance requires a severe trade-off. When you put money into private equity, it is locked up. You cannot touch it, withdraw it, or rely on it for a decade. Then you have the purely speculative edge of the market, venture capital and cryptocurrency. These assets provide the ultimate lottery ticket scenario. Funding an early-stage tech startup or buying the right digital token carries the mathematical possibility of multiplying your initial cash by 100 or even 1,000 times. But the baseline reality of that sector is failure. Roughly 90% of funded startups collapse entirely. Bitcoin, the largest cryptocurrency, dropped 64% in a single year and operates with 5 times the volatility of the stock market. Foundational investing is the mathematical process of letting broad economic growth carry your wealth forward. Speculation is taking concentrated bets on unproven outcomes. Generating massive market-beating returns demands a steep price. You must surrender access to your capital for years at a time, or stomach catastrophic double-digit drops in your net worth. Effective investing is less about discovering a hidden, superior product and more about matching a specific financial tool to your current net worth. This scorecard breaks down the exact blueprint. If you are starting with $1,000, you ignore private equity and hedge funds completely. You allocate everything into a broad market ETF, set up automatic contributions, and close the app. At this level, low fees and decades of patience are the only leverage you need. If you reach the $50,000 mark, you become a balancer. You keep 60 to 70% in your ETF core for growth, shift 15 to 20% into stable bonds, and keep roughly 10% in fixed deposits to absorb sudden life emergencies. Only when you surpass $500,000 does adding complexity make mathematical sense. This is where you optimize, slowly blending in tax-efficient municipal bonds or alternative investments, because your core foundation is already permanently secure. Taking next month's rent money and gambling it on highly volatile crypto will ruin you. Taking 30 years of retirement savings and hiding it in a 4% CD guarantees inflation will eat your future. Keeping all your money sitting still in cash is a guaranteed loss. The erosion is invisible on a day-to-day basis, but inflation ensures your money buys a little less every single year. Compound interest ignores your hesitations, your fears, and your choice paralysis. It simply counts the years you were in the market and the years you were not. The most expensive financial mistake you will ever make is not missing out on a private equity deal or a billion-dollar hedge fund. It is letting the fear of choosing the wrong option stop you from starting today.